Hi, my name is Shlok Srivastav. I'm the co-founder of Appreciate. I'm sitting here today with Mr. Rohin Pagdiwala from Pagdiwala Investments. Rohin has about 20 years of experience, has worked with DBS Bank, Asset Management, has also worked with HSBC in Mumbai and London, right?
Correct, correct.
Rohin, great to have you on the show here.
Thanks, my pleasure.
All right, Rohin, everybody wants to retire early, and clearly we've seen that, you said bye bye to the corporate world at the age of 44. What is it? What does it take to say goodbye to the corporate world, and how do they really, come and arrive at that fact of when are they ready?
For those who may not know, stands for financial independence and retire early. Yeah, it gives you the ability to say bye bye to your main job, to your working career if you do not enjoy it, and maybe pursue something that you do. So, FIRE means that you have enough money to quit the stability of a regular income or your main source of income and pursue something that you may not, uh, uh, you may pursue nothing at all, or you may pursue something that maybe interests you more. So I was able to do that. I've worked for 20 years in the corporate sector, and I think a couple of years ago I decided that that was it. I had enough, and the only reason I've been able to do that is because I've been fortunate to understand wealth management early in my life, and I've planned therefore for a long time for that to happen. If you want to be conservative, you may want to go to about 40 times your annual expenses. So depends on each one's ability to save and ability to spend, or rather requirement to spend. The number may vary. I think 30 to 35 times is a good ballpark to work with.
Got it. So just on that question, I think one of the most common comments that I see in some of these YouTube videos is when you're calculating the 40 times or 30 times your annual expenses, do you factor in inflation, or you say my annual expenses as of today is, let's say, 10 lakh rupees, and therefore 40x is 4 crores, and that is the amount I need to save?
I think the second one, the number of 40 times takes into account the inflation rate prevailing in a country, right? So if you were to do the same thing in maybe a different country, you might 25 times of annual expenses might be enough. But given that India is a maybe higher inflation country or higher growth country, I think 35 to 40 times is what you require, but it accounts for inflation. So you take today's expenses, today's annual expenses, and let's say your annual expenses are 1 lakh a month. 12 lakhs into 40 times is about 4.8 crores. While you've got the other parts of it covered as well, which means you're investing it correctly, you've got the right insurance, etc. So there are other facets to it that someone has to watch out for.
So you've raised a very important point. I think one of the key things to understand is the difference between saving and investing. Both of those terms are used together. However, there's a very big difference between how both of them work in terms of wealth creation and wealth expansion and wealth maintenance.
Yeah, so typically in the Indian mindset, and this is for a large part of people who save money, they in India they still prefer to do it in conservative investment avenues. You would more, which you would say are savings, what you call savings, right? So things like fixed deposits, things like PPF, things like your retirement schemes, etc., are more in the saving zone where you're making money, where you're making lesser return for very low risk. That's the mindset. Then they're unlikely to make wealth over time.
Right.
Because the key aspect of wealth generation is taking risk, and that's the investing side of it. Right? That's what people will mostly call as investment. So whether the risk is through equity investing, whether it's through commodities, whether it's through sometimes even property, but you've got to take risk with your money.
Mhm.
Otherwise, you're not going to be able to generate wealth to be able to retire early.
Interestingly, though, over the past 5-6 years since COVID, we've seen the largest amount of new retail investors coming into the market. In the current state of affairs, the markets have fallen significantly. Mid caps are down about 17 to 20%. And this is perhaps the first time a large portion of the retail investor community in India is seeing the risk associated with investing.
Yeah.
What are, perhaps the alternative investment avenues that new retail investors, having seen this for the first time, should be exploring at this point?
There are several kinds of hybrid funds, but there are 2-3 broad categories that one can look at. First are the multi-asset allocation funds. which will have a mix of equity, fixed income or bonds, gold, sometimes even a little bit of real estate. Right. Then there's the other category which are called balanced advantage funds, which are a very very popular category because they offer the simplicity of just two asset classes, which is equity and fixed income, and they give the liberty to the fund manager to change their allocation over time. So in a market like today, most balanced advantage funds might be 50% in equity and 50% in fixed income. But when they want to be aggressive, they can go up to 70 or 80% in equity as well. So those are dynamically managed. Then there's a third category which is also reasonably popular, which is similar to balanced advantage fund, but the asset allocation is fixed. So for example, it will be an aggressive hybrid fund where 75% of the money or above 75% is typically fixed for equity. And 25% is in fixed income, and that ratio doesn't change. So depending on the need of the individual and depending on the overall portfolio construct, I think investors can pick these products.
And you've also previously advocated for having, diversification in your portfolio, not only from in terms of the asset classes that you're investing in within the country, but also global diversification. In your experience, how does global diversification really work out? Is it meant for everyone? And what are the easier ways to do this?
I think is given the nature of geopolitics today and the interconnectedness of the world, I think some bit of global diversification is necessary. Typically, the advantages of doing that is you get a hedge against currency depreciation. You get in case as an investor you have expenses towards which are likely to be in foreign currency. For example, children's education is generally a big expense, especially parent want to send kids abroad. Under those scenarios, having some money already invested in overseas markets, I think are a good strategy. There are platforms like Appreciate, which will make it very easy, very convenient for people to send money abroad, to invest abroad. There are mutual funds which are available domestically, which can also be used to act as feeders into US funds. So there are various ways to get exposure, but I think about 5 to 10% exposure to global funds or global equities is necessary right now.
Got it. So, for example, the Zomato IPO that came out, the Paytm IPO that came out, the number of new retail investors that came into the market because of these IPOs was staggeringly high, right? My fundamental belief is that, given most of India have a smartphone, they're all connected to the internet. They're all using apps like Google, Facebook, Amazon, Uber. Fundamentally, most of the apps that any common user is using on their mobile phones are all US listed companies, right? Do people get attracted to products that they use?
Hard to say that, honestly, Shlok. I think in some sense, yes, people will, especially in investing in the times of IPOs, people will go after products or IPOs that have an established name and there is, let's say, a lot of visibility for them. So Zomato is a good example of this frenzy for IPOs, and where investors go for a name that they're familiar with, along with the media that it draws, the visibility that it's given us, or rather the media visibility that it has at the time of the IPO. Having said that, there isn't enough of these tech names. You can't invest in Google, you can't invest in Meta unless you do it through a platform which allows you to invest in the US, or you do it through the mutual fund route. And what you're therefore trying to do with Appreciate, I think, is a step in that direction, where it allows Indian investors to have a diversified portfolio of stocks, ETFs, etc.
Absolutely. I think the more important point over here, which sometimes gets missed, is when you're investing in the US, you are not just getting returns on the appreciation of the stock value, but there's also currency which is deployed, right? What are your thoughts on how does this rupee depreciation actually help customers who are, who want to get some foreign exposure in their investment portfolio?
Yeah, so the rupee depreciation definitely helps from an investment perspective from India, right? Historically, the Indian rupee has been depreciating about 3 to 4% per year over the last many years. And add that to the gains, let's say, of the S&P 500 or the Nasdaq or wherever else the investors put in his money, which is typically 8-9% in dollar terms, you're still making 13-14% in rupee terms. So the return for the investor is similar, therefore, to what you would get in India, which is a higher growth market, where 14-15% is the norm that's been the case for quite a few years in equity investing.
So I think one of the other things to actually explore is the number of ETFs in India has been increasing exponentially, right? However, US has always had a large number of ETFs available to invest in. Uh, could you walk our viewers through, what is the fundamental difference between an ETF and a mutual fund? And how should they make their investment decision on what is right for them and how to sort of allocate investments in an ETF or a mutual fund?
Sure. So ETFs, an exchange traded fund, what basically means is it's a passive form of investing where there's an underlying index that the ETF will usually track, and the money that you invest in the ETF will get deployed in those stocks or in those securities in proportion to the index that it tracks. And few advantages of ETFs are they can be bought and sold like stocks, so they're very easy to buy and sell. They are amongst the lowest cost investments available. So the expense ratios of ETFs would be very small, 0.05%, 0.1% in that range. And of course, in general, they are liquid, so they're easy to exit. The advantage that a market like the US offers is the breadth and the variety of ETFs that they can bring, with all of them having high liquidity. In India, that's not the case. There are some ETFs which are liquid, and you get let's say fair price for what you're buying, but there are quite a few ETFs which are not liquid, and
Right.
in those scenarios, I would recommend investors take up the mutual fund option to make those investments in that index. Now, comparing this to a mutual fund route, the mutual funds will have a little bit more expenses, but they guarantee you liquidity. They guarantee you the comfort that it's been managed by an AMC. The governance is better, and of course, you can buy and sell it also from any of the AMC websites, the registrar's websites, etc. So, pros and cons for both. ETFs in general cheaper. If they're liquid, they are probably the better option to buy. An index which is not so liquid and not let's say and there's not enough depth in the market for it, then I would suggest a mutual fund route.
Perfect. So, Rohin, clearly you've done a lot of research. What is your advice for people and how should they start planning their investments? Right, we've spoken about India, we've spoken about US. अब बुद्धि की बात पे आते हैं. Somebody wants to, save. They have a corpus in mind, or they may want to, retire early. How should they start planning their future? Does it start with knowing an amount that they want to save for, or does it start with forming a habit?
I think a bit of both, and there are three pillars that I would recommend that investors think about. First is savings rate. So I think there's too much attention that investors give on where they'll put the money, but not enough is thought of on how much money they'll invest, right? So when I manage some client portfolios, I always look at how much are their expenses, where are they spending the money, at least at the broad level, and then I'll push them to save a little bit more. If you allow yourself to save that 5-10,000 every month over a period of 7-10 years, that money grows manifold, and that small amount, which what appears to be a small amount now, is actually becomes a very big amount. Second is taking risk, and we started by saying that listen, there are too many people in India who are saving and not enough people investing, right? People need to take risk with their money, and typically I would say, depending on what age profile you are, but at least 50 to 60% of your money should be in equity, which is a risk asset. Third factor is time and patience, and that cannot be emphasized enough. And given current markets, that's it's something that people need to understand more. You need to give your money time, and time here means 7-10 years, not 2-3 years. And you've got to give it long periods of time for you to really compound your money and make wealth.
Perfect. So, I think we're at the end of the segment, but I don't want to leave Rohin without a rapid fire round. It's sort of mandatory and sort of the norm in these conversations. All right. We'll try and keep it fun, right? So let's get started. Okay, Rohin's first question. India versus US, which is the right investment destination for the year 2025?
India.
All right. Rupee depreciating. Will it continue to depreciate in 2025?
Yes, I would expect it to maybe hit about 89.5, 90 towards the end of the year.
Okay. One sector in India and one sector in US to closely watch out for.
India energy transition. I mean, batteries, solar, wind. That's a sector that's I see changing a lot, changing how energy is consumed in India. In the US, I think it's obvious AI ML.
Of course. Gold prices given current geopolitical outlook.
I think another 7-8% maybe hitting 95,000 for 10 grams.
Okay. And one piece of advice for investors to navigate the current market volatility.
Invest in quality stuff and be patient.
Perfect. All right. All right, Rohin. Thank you so much for being on the show. I hope our viewers have been able to learn something from your wisdom. And we're more than happy to answer any questions that our viewers may have. And we look forward to the next one. Thank you so much.
Thank you. It's been my pleasure.
Yeah.